Is this a massive value creator or execution failure? Blue Origin's $130 billion gamble. Blue Origin's $130 billion valuation highlights the need to build your enterprise value and secure your investment strategy. Blue Origin's proposed $10 billion fundraising at a $130 billion valuation should remind you that raising capital is only the beginning because investors eventually measure execution, profitability, and long-term enterprise value. You should notice that this is Blue Origin's first external fundraising round after more than 2 decades, ending an era where founder funding alone determined strategic priorities and investment decisions. Around $8 billion is expected from institutional investors, while Jeff Bezos plans to contribute another $2 billion, reducing his ownership from 100% for the first time since 2000. You should understand that institutional investors rarely finance ambitious visions without demanding measurable milestones, disciplined governance, stronger capital allocation, and predictable commercial returns across every business division. Jeff Bezos has reportedly invested nearly $30 billion into Blue Origin since stepping down as Amazon CEO in 2021, showing remarkable commitment despite slower commercialization than major competitors. You should recognize that external funding gives Blue Origin greater financial flexibility, but it also increases accountability because every investment decision must now satisfy professional investors expecting measurable shareholder returns. The commercial space economy now extends beyond rockets into satellite communications, defense, AI infrastructure, cloud computing, lunar logistics, orbital manufacturing, and global connectivity, creating enormous long-term commercial opportunities for you to watch. Governments worldwide continue increasing investments in national security space programs, while commercial businesses demand more satellite capacity for broadband, Earth observation, navigation services, and AI computing infrastructure. Blue Origin is no longer focused only on New Shepard because it now develops New Glenn, Blue Moon, Blue Ring, Orbital Reef, satellite communications, and ambitious AI satellite infrastructure programs simultaneously. Every one of these strategic initiatives requires multi-billion-dollar investments before generating meaningful cash flow, making disciplined capital allocation one of the company's biggest long-term business challenges. You should never confuse a $130 billion valuation with proven operating performance, because premium valuations represent expectations about future execution rather than today's measurable commercial achievements. A company valued at $130 billion must consistently prove revenue growth, operational excellence, customer expansion, and profitable commercialization instead of relying on market excitement surrounding future opportunities. L-Impact Solutions believes your biggest lesson is that financing risk is secondary because execution risk ultimately determines whether premium valuations become sustainable enterprise value over the next decade. You should remember that investing over $30 billion across more than 20 years does not automatically create industry leadership if launch cadence and commercial execution continue lagging behind stronger competitors. Institutional investors buying into a $130 billion valuation are effectively paying for future commercial dominance instead of current operating performance, making execution the ultimate competitive differentiator. Aerospace businesses demand predictable cash generation because launch infrastructure, propulsion systems, reusable rockets, satellites, and lunar missions consume billions before producing reliable financial returns. You should appreciate how expanding New Glenn, Blue Moon, Blue Ring, Orbital Reef, satellite communications, and AI infrastructure simultaneously creates multiple billion-dollar projects competing for limited financial resources. Without disciplined portfolio prioritization, parallel expansion across several strategic initiatives can weaken capital efficiency, delay profitability, increase execution risk, and reduce long-term shareholder confidence. Following the New Glenn launchpad incident, Blue Origin had to rebuild critical infrastructure while NASA continued preparing Artemis 3 for 2027, highlighting how operational disruptions quickly increase financial pressure. You should understand that aerospace success depends not only on engineering excellence, but also on supplier resilience, quality assurance, operational redundancy, disciplined governance, and flawless program execution. Investors increasingly expect Blue Origin to expand beyond launch services because recurring revenues from communications, cloud infrastructure, AI platforms, logistics, and defense generally deliver stronger long-term economics. You should see that becoming an integrated space infrastructure company offers higher margin, recurring revenue opportunities than relying mainly on individual rocket launch contracts for future profitability. L-Impact Solutions reminds you that a $10 billion funding round should never be mistaken for competitive leadership because markets eventually reward measurable execution instead of impressive fundraising headlines. Investors ultimately expect approximately $10 billion of fresh capital to generate scalable technology platforms, sustainable commercial assets, repeatable cash flow, and meaningful shareholder value throughout the coming decade. You should connect every future investment with measurable financial outcomes because institutional investors increasingly evaluate return on invested capital, operating cash flow, and commercial revenue rather than ambitious narratives. Every $1 billion invested should ideally produce measurable improvements in ROIC, customer backlog, operating cash flow, launch utilization, commercial revenue, and overall enterprise value creation. Commercial launch execution deserves your highest attention because recurring launch success directly improves customer confidence, revenue visibility, asset utilization, and long-term operating leverage throughout the business. New Glenn is expected to support NASA's Blue Moon missions, Amazon satellite deployment, AST Space Mobile, National Reconnaissance Office payloads, and future U.S. Space Force operations. You should recognize that increasing launch frequency while maintaining mission reliability reduces average operating costs, improves manufacturing efficiency, strengthens customer retention, and accelerates sustainable profitability. Revenue diversification remains essential because launch services alone rarely justify premium valuations over the long term compared with recurring infrastructure and subscription-based commercial business models. Blue Origin's expanding portfolio across Blue Moon, Blue Ring, AI satellites, orbital reef, and satellite communications creates several recurring revenue opportunities extending well beyond traditional launch contracts. Investors generally assign higher valuation multiples to businesses generating stable infrastructure, logistics, government services, and recurring subscriptions than companies relying primarily on one-time launch transactions. You should prioritize enterprise risk management because aerospace failures can rapidly destroy shareholder value regardless of technological sophistication or ambitious long-term strategic planning. Following the New Glenn launchpad explosion, Blue Origin continued rebuilding infrastructure while NASA still targeted Artemis III for 2027, reinforcing the importance of operational resilience and schedule certainty. You should invest in independent engineering reviews, predictive maintenance, cybersecurity monitoring, supplier quality audits, digital twins, and enterprise risk management before expensive operational failures occur. Supply chain resilience across propulsion systems, avionics, electronics, composite materials, cryogenic equipment, and precision manufacturing becomes increasingly important as launch frequency continues growing. You should reduce supplier concentration risk through multi-source procurement, strategic inventory buffers, supplier financial monitoring, and long-term manufacturing agreements supporting reliable production continuity. Financial transparency should evolve alongside technological ambition because institutional investors increasingly trust measurable execution metrics instead of visionary presentations or optimistic future projections. You should expect quarterly disclosures covering launch success, customer backlog, annual recurring revenue, free cash flow, capital efficiency, customer diversification, gross margins, and ROIC alongside engineering milestones. L-Impact Solutions recommends creating a structured 5-year enterprise value roadmap where every $1 billion invested directly supports measurable customer growth, profitability, commercialization, and cash generation. Blue Origin's proposed $10 billion fundraising at a $130 billion valuation should represent the beginning of stronger governance rather than the completion of a successful financing milestone. The company has reportedly invested more than $30 billion since 2000, while new institutional investors significantly increase expectations for disciplined financial management and operational transparency. You should insist that every investment above $500 million undergo independent board-level evaluation covering expected revenue, technology readiness, IRR, launch dependency, commercial risks, and supply chain resilience. Structured capital governance helps prevent costly overruns while ensuring every dollar invested contributes measurable enterprise value instead of expanding unnecessary organizational complexity. You should avoid allowing one launch vehicle, lunar mission, AI initiative, or satellite program to dominate annual capital expenditure because excessive concentration increases enterprise vulnerability. Balanced investment across launch services, orbital logistics, communications satellites, propulsion technologies, government contracts, and infrastructure services strengthens long-term financial resilience during operational disruptions. Operational resilience should become a measurable business objective because technical failures immediately affect launch schedules, customer confidence, revenue generation, and long-term shareholder value. Following the May 2026 New Glenn launchpad explosion, rebuilding infrastructure reportedly exceeded the original $1 billion launch complex investment while delaying important commercial missions. You should strengthen future resilience through redundant launch facilities, predictive maintenance, independent technical audits, supplier verification, and digital twin engineering before expensive disruptions occur. Thousands of specialized aerospace components supplied by hundreds of manufacturers make supplier concentration, semiconductor shortages, logistics disruptions, and geopolitical uncertainty significant operational risks for long-term growth. You should establish secondary suppliers, strategic inventory reserves, quarterly supplier financial stress testing, and long-term procurement agreements to improve production continuity and delivery reliability. Blue Origin plans Project Sunrise alongside a constellation of up to 51,600 satellites, dramatically expanding opportunities while simultaneously increasing cybersecurity and operational governance responsibilities. You should implement zero-trust security, continuous cyber monitoring, secure software development, quantum-resistant encryption planning, and independent cybersecurity audits before expanding space-based AI infrastructure. Investors increasingly expect quarterly reporting on launch success rates, recurring revenue percentages, operating cash flow, capital efficiency, contract renewals, launch utilization, and free cash flow progression. L-Impact Solutions believes your strongest competitive advantage comes from combining disciplined governance, resilient operations, transparent reporting, and capital productivity, rather than celebrating impressive valuation headlines alone. You should remember that approximately $8 billion from institutional investors and $2 billion from Jeff Bezos fundamentally shift expectations toward measurable financial performance instead of visionary ambition. The expanding global space economy increasingly combines launch services, satellite communications, AI infrastructure, lunar logistics, orbital manufacturing, and defense, demanding disciplined execution across every strategic investment you evaluate. You should evaluate every major fundraising announcement beyond headline valuations because governance quality, execution capability, capital productivity, and operational resilience ultimately determine sustainable enterprise success. Companies converting billions into repeatable revenue, reliable launches, resilient supply chains, and disciplined capital allocation are more likely to sustain competitive advantage across multiple economic cycles. You should remember that valuation creates expectations, but consistent execution transforms enterprise ambition into durable shareholder value, making disciplined governance your greatest long-term competitive asset in rapidly expanding space markets. Can your business turn valuation hype into real enterprise value? Comment your answer below. For more analyses, visit our consultancy website. Link in description below. Thank you.